as their lender. A lot of times people will take the recommendation of a real estate agent like yourself that has a good working experience with somebody that has been known to get deals done in the past. But if a person doesn't have that kind of guidance, where they don't have a agent that is representing them yet, and they're looking for somebody to work with them, because really the mortgage information needs to come first. A person needs to get pre-approved for a mortgage, then start looking for a property. Sometimes people tend to get the order of that a little mixed up. But if they are out looking for a mortgage person on their own, I would say some of the criteria that they should look for are, rankings. There are a lot of sources that are available out there that people can use to see how evaluations have been done for mortgage people in the past. Two of the big ones are Zillow.com, and also you can find things. Even Facebook has, for anybody that's got Facebook pages, you can find a lot of good information on ratings on there for people. I'm very proud of the fact that I've had nothing but 5-star ratings since my time in the business, and I've got over 100 reviews so far online, which is good. And but obviously they want to look at that information. Another big thing they want to take into consideration is personality. Some people tend to work better with certain types of personalities that are similar to their own. And so, of course, just interviewing people for that position and getting to know that person and seeing what their personality type is like, I think goes a very long way. And then, of course, rates always play a part in the equation as well. They want to make sure that the lender that they're working with is an affordable one and that has the ability to, give them a good deal. For the most part, most of the lenders out there in the industry are fairly comparable on rates. That's not usually that big of a difference. So it really is going to break down to customer serviceability and again, personality type. And who they like and trust is invariably, at the end of the day, what their decision is usually based on.
Now, GuaranteedRate.com is one of the top 10 largest companies.
Yes, lenders in the U.S. Mm-hmm, correct.
And is your company, I know are obviously based in Atlanta. Is your company headquartered in Atlanta? Do you have offices in other cities?
No, our headquarters is based out of Chicago, Illinois. We do have a number of locations throughout the United States, in most states at this point. We, as a lender, we are licensed in all 50 states, and we do have branch offices in most locations. Here in Georgia, I run one of the branches, and we do have one other location set up here as well. There are some states that have 10, 20 locations throughout the state. California in particular is one that I can think of that, due to the size of the state, needs quite a bit of coverage throughout the state to do it. Yeah. We pride ourselves on being the local lender. Some people have a negative attitude towards online lenders out there that have just one office, and that's where everybody's located out of. So we are trying our best to be at the local level for people throughout the United States. And you did touch on the fact that we are in the top 10 top 10 lenders in the U.S. We're also one of the only few that's a non-bank entity and that we're privately held. And both of those things make a big difference when you're involved with the organization, as far as our ability to be nimble and adjust to changes in our industry, the ability to implement new products. Like, we don't have to go through a board and a lot of bureaucracy that some of the banks have to do in order to be able to. Sometimes, a bank making changes is like trying to turn a battleship, whereas a privately held company with just one owner can quickly pivot if we need to adjust to local market conditions. And I think that that's had a lot to do with why our company has been as successful as it has. One of the other big things is that we have Scotsman's Guide every year produces a list of the top 300 originators in the United States. Guaranteed Rate is proud to say that we have the most number of those top 300 lenders, more so than any other company. So that says a lot to do with our ability to both attract and retain top talent.
Well, the name of the company, Guaranteed Rate,
mm-hmm.
How does that translate to value to the consumer?
Yeah.
And what actually does that mean by guaranteed rate?
Well, it's not a guarantee per se that we're absolutely 100% of the time the lowest cost lender in the industry. I think if a person were to look long and hard enough, they might find somebody online that could potentially be a little bit less than we are. So that's not necessarily what that means. But if you look at our company's mission statement, we're really about giving a very low rate to our clients, providing excellent technology, and providing really good customer service. And on the customer service aspect, we have something called I'm not sure if you're familiar with Net Promoter Score. It's an evaluation tool that people use not just to evaluate mortgage companies, but to evaluate all kinds of companies out there I believe at the last one that I looked at, we were at about an 86% net promoter score. So just to give you an idea of what that means, you have a survey that you send out to a client after they've conducted business with you, and on a scale of 1 to 10, they evaluate their feeling of how things went with the company. A net promoter is somebody that gives a 9 or a 10 on that scale. And so 86% of the clients that we've done business with per that I looked at, we are getting people giving us a 9 or a 10. That's higher than companies like Amazon, Zappos. That's even higher than USAA, which is one of the highest rated insurance companies out there. So we do a very good job of giving excellent customer service, and we're very proud of that.
Now, where do you have a physical office? Where is your and do people actually come into your office, or is it
Sure, sometimes.
online?
Yeah, sometimes. I mean, a lot of times I talk to a lot of clients over the phone and via email, and I tend to meet them sometimes for the first time at the closing table, but they absolutely are welcome to come to our office. Our office is located at 715 Peachtree Street Northeast, Suite 100. To give you an idea where that is, that's around 3rd and Peachtree, about a block north of the Fox.
Right down the street from our studio, actually. So,
mm-hmm.
Well, it's interesting to note that rates are a key criteria.
Sure.
Now, do rates vary by lender?
They do. They do vary from one lender to the next. We have been seeing a steady increasing of rates over the last year and a half, 2 years really, and but that affects everybody equally. But there is a difference between lender to lender as far as pricing, and that's the reason why it's always important for people to ask.
And qualifications, do they differ from lender to lender?
They sure do. Our company goes the extra mile on that up front. We do a full pre-approval instead of just a pre-qualification, where we collect documents from our borrower, send the file to underwriting, and make sure that a file is totally qualified before we issue a pre-approval letter. A lot of other lenders just do a credit report and an application, and then they run it through an automated system, and then they write the letter at that point. We feel that we're far more thorough in that situation, and that helps the letters be worth a lot more.
Stay tuned. We'll be right back after the break. I'm ready. Welcome back. I'm Lou Whelan, sitting here with Derek Van Dam at GuaranteedRate.com, one of our sponsors of the show. And basically, if you missed any of the show, it's on my website, AtlantaCommunityProfiles.com, and without commercial interruption, by the way. So the question is really with rate, and the biggest two questions are, I would imagine people ask, are concerning rates and qualification,
right,
and processing. How does it So
that's true. The processing, you actually bring up a really good point by bringing that part of it up. Sometimes it's not always thought to ask that. Some of the bigger name players that are in the mortgage industry, which are some of the bigger name banks, that's oftentimes where they fall down. They may be very good in the rate, but when it comes to the actual execution of getting the file to the closing table on time, they often fall down and don't deliver the level of service that a lot of people would like. And, of course, they sometimes can't get people on the phone. And at 5 o'clock every day, they leave for the day. I mean, so there are some advantages to working for a mortgage company as opposed to working with the bank. For example, my clients can reach out to me pretty much any time. I've fielded client calls. I've gotten them at midnight before, and I've chatted with people. Rates are always excellent. But the service level is really one of the big differences that a person would experience between working with a company like ourselves and working with a bank. It's just a different animal. Large banks, they have a lot of overhead. They have a lot of brick and mortar locations throughout the country. They have a lot of 75 vice presidents that they have to pay. That adds up to a lot of expense. They don't always have the kind of money to necessarily pay their originators or their processing underwriting staff, maybe as well as working for a direct lender like ourselves can. So because we generally tend to pay higher because we don't have the same expenses that they do, it allows us to attract and retain a top or a higher level of talent, and that makes the whole experience a lot smoother for them. The other advantage you also have is that with a bank, you have one specific set of programs that you have to offer, and that's it. And if it falls outside of those guidelines, they have to say no. In our situation, we are a direct seller servicer with Fannie Mae, Freddie Mac, Ginnie Mae, and Ginnie Mae's who does FHA, VA, and USDA, some of the government programs. We can go directly to them, but we also have the opportunity that we can go through a third-party bank if we want to. And having that flexibility, and it gives us a much greater selection of programs to offer. So if a person doesn't fit perfectly in the box, I can then look for a different box to which to fit them through. It gives me a much greater chance of being able to get the transaction complete.
So good. That's good to know. You have different opportunities lender-wise.
Sure.
At your disposal, whereas a normal bank would not offer as flexible a lender resource pool.
Correct. It's just more limited that they can only offer that bank's programs. They can't go out and offer other banks' programs, whereas we can. We can offer from a variety of different sources. But again, we often tend to go directly to Fannie Mae, Freddie Mac, and Ginnie Mae because we tend to get better pricing most of the time. And it's also a little bit easier from an underwriting standpoint as well. Most lenders in our industry that are lenders and not banks will go through a third-party bank to run their files. It's called correspondent lending. They work with those lenders in a wholesale capacity to sell their loans to them in the secondary market. Well, those banks can and often do put in overlays in place that they, yes, we offer this program, but you have to meet A, B, C, D, E, F, whatever number of stipulations to do that. By us being able to bypass those banks and go straight to Wall Street with these transactions, it severely lowers the number of overlays that are needed to put in place. So we don't have as stringent of a time getting a loan through to the closing table as perhaps some correspondent lenders would have to deal with.
And it allows for the processing to be quicker, I imagine.
Yes.
Which is very nice to know because time is, once you find a house, time is kind of quick, important.
I would say it's one of the most important aspects on a purchase transaction. Refinance is a little bit different. If a refinance takes a couple extra days, it's not the end of the world. But on a purchase situation, you really need to hit that closing date because oftentimes there's other transactions after this one. And if this one doesn't close on time, then the person that's selling their home and buying a new home, it slows that transaction down. And then, of course, those people are selling their home and potentially buying a new home. And it has a domino effect that really messes with people's lives. It's very important to hit your closing date, and we're proud of the fact that we do that a vast majority of the time. Nobody out there does it 100% of the time. There's always situations that come up that can potentially not be seen on the front end of these files that you do have to sometimes deal with. The key is to keep that to a minimum, and if you do occasionally have a situation like that, to have excellent communication with your real estate agents so that they know what's going on and everybody down the chain is informed.
Okay, so what are the criteria for a loan? We know that interest rates have gone up, and the forecast is that they will continue to go up. Now, does that in any way affect the qualifications? Are qualifications becoming easier or more stringent?
That's a good question. As rates go up, one situation that clients run into is that when we look at their ability to repay, which is a big part of our industry, when we had a lot of trouble in our industry and prior to 2007 and a lot of things were redone in our industry, ability to repay is one of the very things that's closely looked at, much more so than it was in the history of our industry. And ever since that point, it has been. So the ability to repay is often viewed by a person's what we call debt-to-income ratio, or DTI for short. So anytime something gets more expensive, and interest rates going up would qualify for that, then it does make it a little bit harder for a person to be under the DTI ratio that they need to be in order to be able to qualify. So, yes, if rates go up, that does, from that standpoint, makes it harder. But one of the positive things that's been happening in our industry is that we've been noticing that property values have been going up pretty steadily now. Since about 2011 through now, you've seen a very nice increase year over year on property values. And as long as property values continue to go up, default rates tend to go down because most people don't want to walk away from an appreciating asset. Car is a different story. You buy a car, drive it off the lot, that starts to depreciate the moment you do it, unless it's some kind of antique. But homes are a different story. Most properties will appreciate, some more than others, depending on the neighborhoods that they're in and the schools and in the area. But predominantly, when you look nationwide right now, you are seeing property values increasing pretty consistently year over year. As long as that continues to happen, lenders are going to be a little bit more flexible as far as their guidelines, because they're not as concerned about the possibility of a higher default rate. If you see a situation like a market crash in '07, where we did start to see that rate go up, well, then lenders are going to tighten up their guidelines, because they need to really be sure that they're not going to, if they're going to get into an asset that's no longer appreciating, they need to make sure that they're only going for the best of the best. And we did have a window of time there where best of the best were the only people that could get mortgages. Things have gotten a little bit easier since that time. There are some lenders that have that brokered situations that have come out that can now work with people with sub 580 credit scores. You didn't see that for a while there after the crash, but that market has started to come back, and they're doing it much smarter this time around. People called that subprime back in the day, and that had a very negative connotation, but there is a special place for that. The difference, though, is that you have to have people have more skin in the game. And that's one of the differences that you're noticing. A person comes in with a lower credit score, or they're more recently out of a bankruptcy or foreclosure than a traditional lending product would work for them. There are products out there now that can help them. It's just the difference is that they've got to come oftentimes with 20 or 30% down, but at least they can still get the home. Pre-crash, I could get a person with a 580 score at 100% financing. You don't see that anymore. A person with lower credit score needs to come with more money to the table. So those alternative products are back, except they're doing them smarter than they were before, so that we don't run into the same issues that we had in the end.
Do those people have to pay a higher interest rate as well?
Yes, higher interest rate and higher down payment. That's correct, because higher risk needs to be compensated by a higher rate to compensate.
What would be a typical
some of those programs you could see in the 7 to 10% range for some people that are sub 580 for sure.
Okay.
But the point of those is to only keep them short term, and then once they get to the point where they can get a normal loan product, we get them out of that.
I see. Stay tuned. We'll be right back after the break. These are some. What about some of those?
No, we don't do any. We're about to get Georgia Dream, but we don't have it fully set up yet. But I do have another one called Chenoa at the moment that is a down payment product. I probably shouldn't get too much into the details of it other than to express that there is the ability to do it. The better one really is that Good Neighbor Next Door program that can help the teachers, police officers, firefighters, EMTs. That's a real good one to talk about. Renovation's a real good one to talk about, too, because there are a lot of people looking to buy homes.
This is 3, right?
Yeah.
Welcome back. I'm Lou Whelan, sitting here with Derek Van Dam, who is Vice President of Mortgage Lending at GuaranteedRate.com. And go to their website for a great deal of additional information beyond the scope of this program, for sure. And if you missed any of the show, it's on my site, AtlantaCommunityProfiles.com. And whether you're a first-time borrower or an investor or an experienced just moving up, check it out, GuaranteedRate.com, for a competitive rate and working with a very reliable and highly experienced professional, Derek Van Dam. So the old days, we had something called a no-doc loan. Did that die? Is that coming back? Or what is the status?
It did die. It died on the residential side. The commercial side is still a little bit more flexible for people looking to buy commercial properties. There are still some stated products available in that world. I haven't really heard of stated programs, no-doc programs in the residential world since about '07.
Okay. Now, I know you have a lot of different programs that are available to people, and depending on their lots of different demographic variables. would you describe a couple of the different programs that might be available to our listeners?
Sure. Okay, so one program that I really like a lot that is very popular is one called the Good Neighbor Next Door program. That particular product is specifically designed for police officers, firefighters, teachers, and EMTs. It's a program where they can't have owned a home in the last year, and they have to buy a property off of the HUD foreclosed list. So that's a constant inventory that changes, almost daily. And they have to live in the home for 3 years as their primary residence, and it needs to be in a particular type of area. But if they do meet those qualifications, what's great about that program is that it allows them to be able to get into the property for 50% off the cost of the home, which is pretty impressive. A person can find a $200,000 property that they buy for $100,000. The loan type that they get on the new side, even though this is based off of FHA foreclosed properties, does not need to be an FHA loan. We can do it with conventional FHA or VA. The advantage, though, if they do it on an FHA loan, is that same HUD foreclosed list is the same list that they can get properties for $100 down. So not only can they get the property for 50% off, they can also potentially get the property for just $100 down. There are prepaids, escrows, and closing costs that need to be taken into consideration, but all of that can potentially be covered by seller concessions. So it is possible to get a person into one of these homes with very limited funds. I try to be real careful about how I say that, though, because a person can't really have no money in the bank. They need to have enough money to write an earnest money check up front, which is usually around 1% of the purchase price. Plus, they have to be able to pay for an inspection and for an appraisal, and those are usually $400 to $500 each. They can put those on a credit card, but they can't do that with earnest money. They have to usually write a check for earnest money. So I try not to market this to people that have no money in the bank. You need a little bit of money to buy a home, but at the end of the day, it's possible that we could get, if enough seller concessions were in there, they could potentially even get their earnest money or part or all of their earnest money back at closing. So that's always an excellent situation. But 50% off of a home is fantastic, and it's those are some great occupations, for teachers, police officers, firefighters, and EMTs to be able to do that. So I love that program.
Now, the HUD foreclosure list, how would one find that list?
You can Google that. I don't have the exact web address right off my head. I have an email template that I send out to some of my realtor partners that contains that information. But if you just Google HUD foreclosed property list, that's okay. Publicly accessible information, not just within our industry.
Now, do you have a program for veterans? Do you work with veterans?
Yes, VA offers a wonderful program for veterans. It does allow for 100% financing. Our company is doing a special promotion through the end of this year where we are waiving all of our lender fees for them. So that's normally $1,190, and we are waiving that through the end of the year for all veterans to be able to do that. So it's a great program for people that do have VA eligibility.
So one thing that's going on in our industry, in the real estate industry, is there are fewer homes on the market.
Right.
And a lot of people, as a result, are having renovations done instead of moving. Do you have any kind of a product for financing of those?
We sure do. Absolutely. There's one available through FHA, which is called the 203K loan, and we have one through Fannie Mae, which is called Homestyle. Both of which are great products for people either buying or refinancing a property. I tend to do a lot more on the purchase side, so I use it there. Where a person that's buying the home gets not only the funds to purchase the home, but a certain amount above and beyond that to do the repair work on the property. You can often see a person be able to walk into a greater amount of equity by doing this. It requires a little extra work. They don't do it themselves. This isn't DIY stuff. They need to get a licensed general contractor to come out and issue a bid. But it is a wonderful way to get everything in one loan as opposed to having to do two transactions, one to buy the home and a second one later to do the work on the property.
Now, what about just if you're living in the home and just like to?
You can do that. You can do it through a refinance transaction. Yeah, you can refinance the existing mortgage plus get the additional funds above and beyond that to be able to cover the cost of the repair.
Stay tuned. We'll be right back. What about down payment assistance? Do you want to talk about that anymore?
Sure.
Okay. And we're ready, Joey. Welcome back. I'm sitting here with Derek Van Dam, who is Vice President of Mortgage Banking for GuaranteedRate.com, a top 10 lender in the United States. And Derek has been in the business for 16 years. He's a seasoned professional and worked in a lot of different capacities. And we're trying to get a feel for the industry, how you go about getting a loan and how to get the best loan and work with the best qualified people. And one of the questions that is on the minds of a lot of people, I'm sure when they call you, Derek, is what would be the best loan for me? What kind of, there are lots of different products.
Sure.
How do you determine the best loan for an individual?
I need to ask some questions first to get a feel for what their existing situation is. There's no such thing as one loan size fits all for everybody. We talked before about veterans and how veteran programs are perfect. So, knowing if a person is a veteran that was honorably discharged and has eligibility is important, because if I can get a person in at 100% financing, I want to do it. Another product that helps a person get 100% financing, for example, is there's one for USDA. It's for the U.S. Department of Agriculture. And that's meant for properties more rural in nature, and they have to make under a certain income. So I need to ask the questions to find out what area it is that they're looking for to see if they would potentially qualify for it. I'm not going to bring that up unless I see that they're looking to buy in an area, or at least close to an area that would qualify, where I could say, hey, if you go just 10 more minutes out, you might qualify for this USDA product and do 100% financing. And so it depends on a lot of things. I need to ask them about their income. I need to, this is where having an application in front of me really serves me well, because once I've got that, I can then make suggestions on what makes the most sense. Our industry is one that requires licensing, and to get that license, to be able to be that kind of consultant, to give those kind of suggestions to people is important. So we need to do our homework ahead of time to be able to offer the right product to the right person.
Okay. So you work with first-time home buyers, I know.
Very often, yes.
And tell us a little bit about the dynamics of that aspect of the mortgage industry.
Yeah, first-time homebuyers, they do make up a big percentage of people buying homes, especially when you look at the data on millennials and them coming up into the ranks. The average age that most people buy their first home is about 31 years old, and we have that millennial generation, which is the largest generation, getting very close to being an average of that age. We're only a couple years out from that, and there are a number of people from that generation that are already there. And so a lot of people are looking at buying homes for the first time. I like the fact that I deal with a lot of first-time home buyers, because I've learned to slow down the process and explain it in an easy-to-understand way. Here's what comes next, and here's what comes after that, and here's what comes after that, because some people get nervous about the process because they haven't been down the road before. So for those people, I just think that slowing it down and taking the time to explain A, B, C, D, E, and what happens in the process goes a very long way with helping them feel more comfortable with the process. So I like to think I do a good job with that. But there's also certain products that are designed for first-time home buyers. There's some first-time home buyer options that can allow a person to get in with a lesser down payment. There's some down payment assistance products that are available out there. Also, again, most of the time designed for first-time home buyers to help them buy a home. And, if I know that that's the bucket that they're in, then I can start discussing some of those products with them to help them out. Because first-time home buyers, by and large, are usually the ones that have the hardest time coming up with the down payment money. Most down payments are usually between 3 and 5% for most products out there. Not everybody has that. I need to know if that's the case, because then I need to roll into some of the alternative products. If they're a veteran, again, that's great. If they're looking in a rural area, that's great. But if not, I need to then roll into down payment assistance to see if I can help them. A person that's selling an existing home, it's a little easier for them, because oftentimes they're getting some equity from that sale of that existing property, and they can use that to roll into a new property. So it's not as important for them, but for first-time home buyers, it's crucial to be able to offer products of that nature.
One of the criteria, I'm sure, is the income, one's income to the size of the mortgage.
Correct.
What do you recommend in that area?
Well, a person can't do anything about their income. They make what they make. It's I just have to look at it, because you can't, for many of these programs, you can't make too much money, because down payment assistance is designed, same just like with USDA, it's designed to help people in certain buckets, to give them a boost up and help them get a property when they might not have been able to do so otherwise. But at the same time, they can't make too little money either. Otherwise, they don't clear that debt-to-income ratio that we discussed earlier. So there is a Goldilocks-like land in the middle there that I have to make sure that they fall within. In certain programs, you can work around that situation. If a husband and wife apply together, you can potentially take one person off the loan to get to within a certain criteria. And that's some of the things that I look at when I'm reviewing their application to see whether or not they would fall into that window to help get them to where they're going to get the best possible option.
So now, do you see prices rising in the metro area?
Property values?
Yes.
Oh, yes, absolutely. For most of the things I've been looking at for around the state of Georgia, we've been seeing a 6 to 8% average increase year over year from 2011 till now.
6 to 8%.
6 to 8%. Now that's potentially slowing down a little bit. We've noticed a little bit of a softening in the market just recently on existing home sales. So maybe that percentage will decrease a little bit with it if it stops becoming quite as solid of a seller's market as it has been, and things start to balance out a little bit more with it between being a buyer and seller's market. Then you might start to see that appreciation slow a little bit. But for the last 7 years, it's been incredibly strong.
Well, when we get back, my producer's over there telling me I have to hurry through this segment. But what we want to talk about is, what I'd like to talk about is the difference between jumbo loans and conforming mortgages, giving people a different feel for different types of products that are available.
Mm-hmm. Sounds great.
So stay tuned. I'll be right back. Welcome back. I'm Lou Whelan, sitting here with Derek Van Dam, Vice President of mortgages at GuaranteedRate.com, branch manager. And your office is on Peachtree Street, right down the road from the studio. Derek has been in business for 16 years and is a seasoned professional, operating in a lot of different capacities and mortgages, and certainly a leading expert in Atlanta. We're grateful to have you on the show and as sponsor of our program. And we wanted to talk about in this last segment a couple of different things: adjustable rate mortgages, jumbo mortgages, conforming mortgages, and help people get a feel for the different products.
Okay. Well, an adjustable rate mortgage is also known as an ARM for short, is in certain cases a right product for people. There's been a lot of maybe bad press over the years about adjustable rate mortgages, because if you come out of an adjustable period, there's the possibility that a rate could increase. But they're not always a given. An adjustable rate mortgage is tied into a particular index. That could be the U.S. Treasury bill or LIBOR, which is the London Interbank Offered Rate, or other kinds. And there's a certain margin above that particular index. And depending on what's going on with that index will determine what's happening with the rate at that time. But on most ARM products, the vast majority of them, they're called hybrid ARMs, and they're fixed for a certain period of time. 1 year, 3 year, 5 year, 7 year, 10 year, okay? The longer you fix that rate for, the higher the rate is, and vice versa. Most of the time, I think a 5, 7, or 10-year ARM could be a good product for the right person, and it depends a lot on how long a person thinks they'll be in the property. So that's a good question for us to ask up front to find that information out, because if the property is going to be short-term, to get a 30-year fixed product may not make the most sense, because they're going to generally get a lower interest rate on an ARM than they would over a fixed rate. And if they're not going to be in the product long enough for a 30-year fixed or a 15-year fixed to make sense, then an ARM could potentially be the right product for the right person. Again, requires the right questions on the front end. You need to know who you're working with and what their time frames are, and that's usually why I ask those questions up front. Overall, ARMs make up about 2% of our current selling mix at the moment, so it's not like that many people are taking them, but I do think they make a lot of sense. And if you tend to look at a lot of people in our industry, the people that actually do mortgages, most of us have ARMs, because we know what buying patterns are on average. I think most people on average usually refinance a home every 3 years, buy a new home every 7, yet everybody is out asking for 30-year fixed, and they're getting this great fixed rate that's fixed for 30 years. But the number of people that carry that rate to term is very, very small.
And the difference between a jumbo and a conforming mortgage for people.
Based off the loan amount. So the difference is the cutoff point here at most counties in the state of Georgia is $455,100 is that cutoff point. So if you have a loan underneath that, you fall most into the conforming world, Fannie Mae, Freddie Mac. If you are over that, you then move into the world of jumbo. There are some different parameters for jumbo. The rates are fairly comparable. They're not that much. There was a period of time where they were a lot higher. It's not quite that different anymore. But sometimes there's a greater down payment percentage. So with a conforming loan, I can get a person in, within 3 to 5%, depending on the loan type in many cases. Whereas on jumbo products, a lot of times they want more. In most jumbo lenders out there want a person to come up with 20% down. We are fortunate to have some that offer a lesser down payment than that, which is good. Another option that I've used in the past that's been effective is to get a person out of jumbo range. Let's say, for example, they're at 550, 600. Sometimes we can do a first and a second mortgage. First mortgage, we cap at that 455, 100, and then we do the second. And by doing so, we keep the overall, we keep it in conforming realm for the first. So that's a technique that I've used in the past that's been effective to help maintain and lower a person's down payment amount.
Thanks for coming on the show, Derek. Great to have you. And again, his website is guaranteedrate.com.
Well, my personal website is rate.com/Derek Van Dam, and my name is spelled DEREKVANDAM. And that's my own personal page.
Perfect. Thanks for coming on the show.
Thanks for having me, Lou.
Thank you for listening.